So today we have our dear friend and fellow investor whose name is Arvind Kothari. He's the founder and director of Niveshaay, and he has been practicing equity research and investment advisory for more than 12 years. And he has given the shape to a company called Niveshaay, which is like his pet project. And he has a vision that Indians should invest at least 10% of their savings in capital markets. And I'm sure all of you who are here, you are regularly investing in markets. So his approach will be very, very powerful and useful to all of you. He initially, used to work with a company called ICICI Bank as an industry research analyst. And he was, perturbed that, all these companies don't focus on too much of ground level research. And he wanted to, have something of his own where we can spend time and energy in focusing on ground level research, which is also called Scuttlebutt Investing. And we'll learn more from him in terms of his approach, how he does. And he has this Niveshaay Investment Advisors firm, which is a SEBI registered advisory firm. He's a chartered accountant and also a fellow CFA, so he's also a chartered financial analyst. And he has this inherent passion of going deeper into economics of things and going at a ground level. So let's all welcome our dear friend and fellow investor, Arvind Kothari, who will help us understand the entire process of Scuttlebutt investing, how he does it, and what it takes to be a fine investor and achieve success in his journey. Yeah, so over to you, Arvind Bhai, and great to have you here on this platform.
Thank you so much, Vivek Bhai. And sometimes, these sessions are quite, helpful because they give you the confidence that you're a good investor, because market needs a lot of patience and a lot of long-term approach to, be successful. We can look very good on the books, and these sessions, you get the appreciation even before performing, right? Market only gives you the required returns when you perform. But then I'll just share you few of our approaches and few of the case studies that we in our organization observed that made wealth. And the whole purpose is to look at a lot of companies in India from the perspective of businesses which are doing exceptionally well, because over here the promoters are hardworking. They did not have a lot of, you can say, motivations for market cap previously maybe, but these days the young generation also looks at the market cap. And if you compare these businesses to what happens around the world, you'll find a gem of businesses which sometimes are under the cover, sometimes are not discovered. And if you stumble upon them, you should not miss the opportunity, is what the whole purpose of the session is, right? And that is where I guess when I met Vivek Bhai, he shares the similar passion. I guess he's working tirelessly for your community day in and day out for bringing those kind of companies to your notice. And his approach also I appreciate, because I have over the years developed friends who also have approached investing from both fundamental and price volume action analysis, and have come up with investing gems. So I guess already you are in company of Vivek Bhai, who's excellent in that. I'll just try to touch upon the things that we in our organization have observed, things which might not have worked, things which might have worked, and over the years what we've realized, our approach has graduated to something which we believe has now a better shape, right? Because initially everything is gray, and then it tries to come in a shape. So that's what the whole purpose is. And end of the session, we'll have some Q&A. I guess Vivek Bhai would be having that in mind also, right? So let's start.
Yeah, and just to add the connecting dot, Arvind Bhai is who creates the price volume action. Okay, so when he punches the order, we see the price volume action. So we will see the real ground level thing, how all these things happen. And then after doing all this hard work and analysis, when they come to the final punching the order, what happens, right? So that is what the magic we are going to see. So it's like what I call the Peter Lynch way, so what Peter Lynch used to do in US, that is what Arvind Bhai is doing in India. Okay, so let's focus on what he does, the magic in the ground level. Yeah,
so that's too big a tag which Peter Lynch used to do. But the point is that the approach that Peter Lynch had, or maybe Philip Fisher wrote in his book, a lot of things which might not apply in India, right? So you have to graduate towards a strategy which works in our Indian condition. I tell this to a lot of young people that whatever you read, abroad, or whatever books are written, they are mostly written on, economies which are very, very different than our economy, right? So you cannot, so in cricket, you cannot practice on a Eden Gardens and perform in Lords, right? You have to practice on the ground where you want to perform. So the point is that our Indian conditions and companies in India like Astral, Poly, and all these commodity kind of companies have become brand, right? In around the world, I've never seen these kind of commodities being brands or having distribution power, which a lot of building material companies in India have, or a lot of, you can say, even commodity plays in India have. APL Apollo for that example. So there are very different. India is a very different market. We've seen different types of businesses getting appreciated a lot, and the businesses that have been appreciated in the West a lot not getting appreciated at all for a long period of time over here. So you have to understand that what works in India is something when you move around, when you look at the country, when you look at the distributorship, when you look at people who are buying brands, when you look at people's purchasing behavior, when you look at how businesses are being run, you come to know how difficult it is to do a business in India, right? And even if you don't have a brand, but if you have a scale that you've developed over here, the capitalism comes very late sometimes, and you enjoy a larger period in simple businesses also, where the profitability comes in huge chunks and the cash flows can be deployed over a longer period of time than in other kind of geographies where competition kills you very fast. So that is where we believe that India market is very different. And though we, the coin or the term that scuttlebutt investing was coined by, Mr. Philip Fisher in his book called, Common Stocks and Uncommon. You should read that. I'm not saying that you should not read. That gives you a starting point that how things should be done. And he has these templates that what you should do when you're going to the market, what you should do when you're observing their, creditors and things like that. But, this approach has been used by masters like Warren Buffett when he was investing in American Express. But the one person, Peter Lynch, who used it and extensively benefited from it, and hence it got, formally, you can say, in the world known as the Peter Lynch way, is something which is very intriguing, because Peter Lynch ran a very big fund. He was not like a single person who was, investing in brands for his own family and making a killing out there. He was investing for a Magellan fund, which was a large size fund, and it was the longest, you can say, performing fund in the history of our planet. And that's where this gives credibility to this approach, that it works in the longer term and on a larger pool of money also, right? So in scuttlebutt investing, generally what people think is you should go and check products in the market. You should look at what is happening around, which products are becoming successful, what are the products which consumers are liking. But in India, the problem is many a times these brands which are being appreciated in the market, or these brands which are becoming big, either they are public, or sometimes what happens is, even though the brand is very strong, the corporate governance around the company is not so great, and hence they become uninvested, right? It is very, very difficult for you to profit by just observing the consumer's behavior, right? That, for example, you went to a supermarket and you saw that a particular basmati rice, is becoming, very much used, and the brand is, having its presence more, and you observed, and we did that, right? We did it for a basmati rice company, that we observed its prices across various seasons. We, its shelf visibility, how it is being purchased. We talked to a lot of the, retail guys, that what is the, the popularity, and whether it is, in a week, how many packets are being sold, and all kind of crazy things. But the point is that the corporate governance around the company, when we visited them, right, we visited them in the north, and we saw the plants, we met the management, four brothers, their younger generation, everyone very energetic. And if you go, and in Delhi, and promoters who are from that background, they typically are very, very much hospitable, and you feel good around visiting them. But the point was that we were in a way, when we looked at the balance sheet and the cash flows, a lot of things did not match when we compared what should be there. For example, the packing cost, right? The packing cost, which could be easily verified, that the number of packets that they might be selling at those volumes and their competitors were selling, that packing cost was almost 3x what it should have. right? The travel cost, for example, the travel cost for such volume of business, which other people were also doing, were almost 4x of what it should have happened. So that made us believe that we kind of got lured into because being a scuttlebutt approach, we went, we saw the brand, successful brand, advertisement, this that around, growing very fast. A basmati as a category, and India has an advantage in basmati, right? Because India and Pakistan, there are only two geographies in the world which produce the basmati. So we as a regional, you can say, monopoly is with these two areas, and we provide basmati to the whole world, and it is being exported out of India and Pakistan. A lot of the brands in UK, in US, wherever you see, these are Indian or Pakistani companies who have 40-50% market share in that segment. So that way, it was a very good business. The promoters on the face of it look very, hospitable, and, they welcomed us and all things. But when we looked at the numbers, we were not satisfied that what they were doing, to show the numbers or what was happening behind, we were not comfortable, and money didn't get made. In fact, we had to exit at a 20-30% loss to our position, and still we have never gotten back to it because we think that it will take a lot of time for the new generation to fix the corporate governance standards, and hence it is something which, in India, even if you find a great brand who has almost, a market share of 40-50% in a product category and is growing at very fast rate, money doesn't get made, right? So you have to do a lot of things, and you have to use a secondary order approach, because there'll be a guy who is packaging for this brand, and he has a corporate governance standard which would be huge, and that gives investability, and that creates wealth over a longer period of time, right? And so that is where we have to maybe differentiate, as I was discussing with Vivek Bhai the other day, that Moltec packaging, if you look at that company, right, if you're consuming an ice cream, if you're looking around whether you're consuming a ghee, the plastic ghee packs that have replaced the tin ghee packs, or the ice cream packs which have replaced the traditional packaging of ice cream, when you look at some standard companies who made the packaging very beautiful around it, and it is also present in a lot of B2B categories where it is replacing the existing way. For example, paints, where the earlier tin boxes are being replaced by this. Asian Paints, for example, was becoming a very big client for this company, and hence when we looked around, the promoters, we met them, they were so hardworking, right? They were visiting these brands with new products, with full energy, that boss, I can solve this problem of yours with this packing, this will create this cost advantage, why don't you look at it, again and again and again. And that drive to get market share, the drive to offer better products to their end clients, was something that we were very interested in, because it is a package. In a packaging industry, we've never seen big companies emerge out of the US or in other markets. But these guys, in their business, we didn't find anyone else who is doing such a wonderful job, or who has such energy and who wants to innovate continuously and solve the problem of the customer. So that worked out better for us than the end brand. So you need to understand that in US, the end brands have done far, far better, because their corporate governance more or less is same. Hence, you go for a better business rather than, a business which can be commoditized over a period of time. In India, on the other hand, you've seen huge money being made in B2B businesses also, or companies which erstwhile were into commoditized kind of businesses, but eventually could turn out into a brand because of their scale, because they had good corporate governance standards around, they had great management, energetic management, who were winning business from their competitors because they were not efficient enough, right? So that is a very big, you can say, differentiator, I'd say, when you apply, a scuttlebutt approach in Indian context. And our philosophy has always been to think like an entrepreneur, right? And in our office, if you visit, right, we have these walls where we almost respect, and in fact take these entrepreneurs as our gods, because we are because of them, right? I mean, we generally don't take a lot of these finicky kind of positions where a quarter, if they don't perform, we ask questions to them, or doubt their integrity, or pose a lot of a discomfort within them, because we feel that businesses don't happen in a straight line, right? They have a lot of ups and downs. And if promoters are having a vision, if they are wanting to fix the business model over a longer period of time, what is happening in the short or medium term is something that we are comfortable with, to deal with volatility, with that volatility. And because, see, when we are approaching investing, many a times, as Vivek Bhai said, we will be punching orders and moving the price around, right? And when I'm buying a large stake, right, getting out of it in a jiffy or with a discomfort of few matters is something which is not in my interest or my investors' interest, because then I'll only be bringing the price down. So till I'm not comfortable that these promoters have the grit to perform in the longer term, they have a business model in mind which should work in the longer term, it is very difficult to get in and out, because the volumes in these kind of companies in India is sometimes very dry, and you cannot enter and exit at your will. And that is where you have to be very, very sure what you're doing. And hence, I'm not saying that we don't at all buy companies for a medium term. We do buy companies for also a couple of years, where we feel the cycle has turned very bad and the valuations has corrected so much that a cyclical upturn can result in huge valuation upside. And that's where 30% of our portfolios are cyclical also, but 70% we try to gauge the long term, you can say, journey that the entrepreneur wants to write, what vision he has, and in the meanwhile try to get to know him better, because I cannot have a higher allocation at upfront, right? So if I know Mr. Shrivar Kheruka or Mr. Pradeep Kheruka of Borosil or Mr. Himanshu Patel or Alap Patel of HLE Glasscoat, I will increase my allocation as we know them more, as we try to find more nuances of the business, as we discover that these businesses can perform at a certain scale even better than what they're performing at this scale. And hence, when we meet them, we don't ask them what they're going to do in a quarter or two. We have this approach where we'll do the whole thesis ready, what happened with such kind of an industry when it was, for example, Borosil Renewables, what happened in China, right? How the glass companies in China grew. We had a duopoly kind of a market in China where two companies almost were 60% market share and were making 45% kind of gross margins for a glass business. Right? 45% gross margins unheard of, right? And in India, the Borosil guys couldn't even make 10% margins, right? So we knew, because that was of the dumping that the Chinese were doing. We knew it was not in India's advantage, because Chinese used to make for their own country and for exporting to the foreign countries, and the excess capacity was then being dumped to India. So when there was, huge, you can say, a step taken by the government to put the anti-dumping duties in effect, and many a times, a lot of investors say, ye anti-dumping duty agar 4-5 saal baad chale jayega, fir kya? Right? But that is the time space that our entrepreneurs require. 5-7 years of this anti-dumping duty gives them this breathing space to grow the margins, to improve the business. For example, for Borosil Renewables, they got the cash flows to improve their furnace. So when we used to visit a lot of our friends who were into module manufacturing, see how we stumbled about the idea was that we have this 40 to 50 people, a group of entrepreneurs whom we try to visit every year, and in a quarter try to talk to everyone, and in a year try to visit them. And then we ask them what is happening in their business value chain, what difference they are feeling in the way they were doing business maybe last year, what it has changed. And if something substantial has come up, then we try to dig down into deep. And we had a friend who was into solar module manufacturing. And why I'm telling you that why we should think the entrepreneurial way, because the entrepreneurs are creatures who definitely all their conscious and unconscious mind is focused on what I'm going to do and how it will affect my business over a longer period of time, rather than thinking what I'm going to do this quarter or that quarter. And this has been a great characteristics of all good entrepreneurs that I've met. They have 4, 5, 10 years in their mind rather than a quarter or two. And that's the difference between an investor and an entrepreneur, right? As investors, we want to make a quick buck, right? We want to see where the 6-month, trajectory of earnings is going to look like, and try to be in hot sectors or hot companies where we'll make a quick buck and move around, right? So that is where large upsides are created. When we are able to get into the mind of the entrepreneur, that how he's planning the business for the decade or a 5-year time horizon. And when we meet these people, it is sometimes the drawing board we sit with their family members, right, and try to understand how they're going to structure their business. Sometimes they're unlisted companies. In fact, many a time these are unlisted companies, and that is where they're more comfortable, because when we are researching about a lot of sectors, they also want inputs from us, and hence the discussion becomes very intense. And a lot of times these gems come out like Borosil Renewable, because I still remember that when we sat with a few of our friends which were into solar module manufacturing, they said that somehow the structure of the business has changed so dramatically that the Kherukas, they've become like the Amitabh Bachchan of their industry, because whomever they will supply the glass to will be the only players in solar module which will survive in India, because getting glass from Chinese importers had become impossible after the pandemic. They were not interested to do business. They were not responding to their phone calls, not responding to their mails, as if they had shut shop in India. That was the kind of behavior that the Chinese glass importers were having with the Indian module manufacturer. Because as it is, this business they were doing just because of excess capacity. When they did not have excess capacity, they thought, why we should entertain, right? So in China 2018, the government over there told, you should not be manufacturing more glass because it is polluting. So it made capacity curves, but on the same side, the demand just grew out of control because of the solar boom. And that is where we thought that what is happening with the business of glass in India is a long-term change. And the Kherukas had already given, and if you look at this company for a decade, they did not do anything. They put up a glass factory of solar glass way back in 2010. And for a decade, they didn't do any expansion. The decade they didn't do anything. They were just surviving. It was like they were just dodging, the Chinese competition, just trying to survive. In fact, around the world, all solar glass plants just decimated and went out of business. Only 2 plants in the world survived. One was Borosil Renewables and the other one in Europe. And that is where, when these guys got the opportunity, then now the government is going to back us and the Chinese have these capacity curves, let us come in the overdrive. And if you would have visited these solar, guys earlier, they would have said, we don't buy from Borosil. We only buy 5-7% quantity if we don't have imports coming on time, because the breakage issues with Borosil are there. And, we find it more expensive and things like that. But in 2019, just before the pandemic, these guys improved their plant. They overhauled the existing plant and in fact expanded the capacity by putting up a new furnace. So a 180 ton capacity per day plant went up to 450 tons capacity, and they did a capex of 200-250 crores, and still the market cap of the company was 500 crores, right? So for a decade, a business has survived. Forget about the capex they did earlier. They did a fresh capex of 250 crores. The capacity had went up 3x. Still, the market did not appreciate much. The market cap might have just moved by 40-50% by all this that had happened. And we had a cocktail of events which could completely, give this business a new trajectory. And the market just kept on ignoring it. And we with our report, we approached a lot of value investors. And we were said that, you're not looking at the right direction. Look at what has happened. We're just recovering from a pandemic. There are so many good businesses to look at, right? So many good established business are available cheaply. Why we should look at an emerging, theory? So that is where we thought that, either we were horrendously wrong, or either the market would, be surprised, very highly, because here the earnings trajectory could have changed whatever profitability they were making to 5-7x extra, of the profitability that they were making. And still the market cap had just appreciated 20-30%. And that is when we as Vivek Bhai said, that we made the charts, right? We went in and bought, and it was almost a 20% position in most of our family accounts.
Wow.
And we were in a way hoping that the market sometime, in the near future realizes its worth. So at least our investors are not that uncomfortable with a high position. And that's where we did a lot more scuttlebutt, that in the short term, we could not be very wrong with such a large position.
Yes.
Because when you buy such a large position, in the short term also, if there is some untoward event and it falls, then handling the emotions of the client is very, very difficult, right?
Correct.
So when you're going with such a high position, you have to do a very high level of due diligence, so that at least the short-term numbers don't have a huge surprise.
Super,
right?
Super.
So
and some of the key learnings, just to highlight, so
yes.
whatever, Arvind Bhai said, so think about sector tailwinds, right? Where it is very important, like 10 years, the tailwinds were not there. And now sector tailwinds started coming in. Also look for new, right? Something new which is happening, like new capex is happening, new improvement areas are there. So all those things, in combination creates the magic. And if you are able to pick that up, like how Arvind Bhai does from the ground level research, that is even better. right? So just summarizing some of the learnings. Yeah, please carry on.
Thank you so much, Vivek. So the point was that, these things, when we look at it, we tell our research people also, we are looking at a business from the point of view of, like an entrepreneur, you're putting up a plant, you have to do a capex of 500,000 crores, whatever. What are the competitions in the market? What are the nuances that you need to learn? What can destroy your business? We pen down everything so that if a businessman is uncomfortable in his own business, we should be uncomfortable in the position, right? And we should be selling out. And as a businessman, if we face tailwinds that we didn't have for a decade, and we are lucky that we are in it, we should not be selling out soon, because that is a chance that we've got after a decade. See, why investors sell out in hurry? They look at the price action, right? Not the price action, but the doubling or tripling of their position, and they feel we made a lot of money.
30%, Arvind bhai. So that is the problem, right? When people don't have research, just 20-30% move in 1 month, they will see and they will sell it out. They will say like, oh, itna sara return ban gaya, but they don't know the whole picture, like what is the potential in that business, right?
Correct.
So that is,
and that is what I'm saying. See, thinking like an entrepreneur, आपका 10 साल पैसा नहीं बना है, तो आप क्या बोलोगे 20% रिटर्न में I'll not be satisfied. No, I have to make good of the 10 years of not making money.
Yes.
So that means I have to go 5, 7x so as to make good of the past lost decade. So that is where holding your winners comes, rather than flipping it for something which would look exciting in them, because in markets everything looks exciting at a price, right? And you will get a lot of things, but getting focused is something that only comes when you think like an entrepreneur. And that is where off late, and we were of the same, I'm not saying that we were born like this. In fact, we used to flip businesses very early, and that was a problem at Niveshaay, right? So in our history, we had winners like Garvare, Waldrobes, or identified. I joke this to a lot of people that the Little Champs portfolio, which a very big fund manager has made right now, most of these companies we were researching at 1/10 of the market cap, and we had in our portfolio. But credit to him, maybe he's holding it for the longer term. We at that point of time did not have the maturity to hold them for a longer term, which we have changed over the past 5-6 years. And that is what we've seen has contributed to maximum to our returns. When we've got these high allocation bets, right? And these high allocation bets, we've not sold it in a hurry. That only comes by thinking like I'm in a business where I'm here to make money, because I have not made money, or I have changed the trajectory of earnings, which should make me money over a longer period of time. And that's what happened with Mr. Himanshu Patel or Mr. Shivar Kheruka in the businesses, which for a decade Swiss Glasscoat didn't do anything. And JMM Fodler's market cap went up, almost 7, 8, 12x. And that is where, when this family, Alap Patel's family came, we were very sure that the trajectory of earnings could change, because the earlier promoter had 2 daughters and he wanted to retire, and since he didn't have any interest to grow that much. But this family, Alap Patel's family, Alap, in fact, newly married, I know he's my friend because we were in the same city. I knew him personally, how hardworking he was. And he was traveling 5 days, a week to Anand, and, used to come back to his family on a weekend. That was a kind of hard work he was putting, and the family was so rich, they didn't had to do it. But the growth, mindset that they had, it was so much into them, because for the third generation, these were the entrepreneurs who had done huge changes in the whichever business they went into, right up from their grandfather to their parents, and now Alap and his brother Harsh. So that is what something intrigues us, that the trajectory of earnings depends on what the entrepreneur has, the tailwinds in the sector, plus their own ability to capture those tailwinds. And when there is a marriage of these two, you should be betting high and you should be betting for the longer term. That is what, over the years, we've defined our Scuttlebutt to find whether these things are in place. And that's where we focus more on small caps, because in large caps you don't have these driven people. Large caps generally have systems where people are incentivized only till their salary pays. They're not incentivized very high to think like an entrepreneur, and that is where we generally have a lesser interest. And that is where generally we believe those small caps can be highly volatile. They are mispriced most of the times, because people are always doubting them when they're small, because price would move so fast, and they will have such small market caps, and even they'll fall down 20-30% in smallest of events, and that will make people think that generally I think get this, you should not buy this because ye promoter chore hai. I mean, just because a company is small, people tag it ke ye promoter chore hai. They will have no background, right? They will have no, in fact, the corporate governance events that they'll highlight that this is why they think actually has been abused a lot of times in the large cap, but they'll just ignore that and they'll just focus on this when it is a smaller large cap. So the taboo of a small company doing something is so high. That's where we believe these mispriced bets offer these opportunities, because that is something, if you dig down deep into, you'll realize that that is something, because of being small, people are maybe raising those allegations even at a larger fervor. And generally we've seen people focusing a lot on sectors that will make huge return, and these high flying sectors they are focused on. We also focus on high growth companies or high growth sectors, but then in the high growth category the disruption is highest, right? So we try to place something as a second order effect or an ancillary play to the technological shift that is happening, because whatever has happened in the past, and Buffett very beautifully in his AGM last year had highlighted that in automobiles, right? If you think about Henry Ford, maybe he was successful, but in US 2000 companies came into the automobile business since 1930s, and there are only 3 who survived by 2009. And that was a huge disruption, which we should always keep on our mind when we are talking about maybe EV revolution, right? So the EV revolution, how it will bring winners is a question mark, but people are betting their hard-earned money right now on companies which they believe can make good models of cars in a EV. But how this technology would eventually mature, and whether Tesla would be a winner, or a Maruti Suzuki would be a winner, or a Greaves Cotton would be a winner who has a scooter, which electronic scooter which they've launched, whatever, we don't know, right? So what our approach is, if we look around that the EV theme is going to be successful, what are the companies which can enable that, and which are those companies which have products which can have their sales growth similar to the end products growth, but at the same time are not at the forefront of the technological revolution, or are not prone to disruption much. And if you look at a company called Shivalik Biometal, run by Mr. Guman and his partner. So this company is a small company based out of Solan in Himachal Pradesh. They have their plant, but this is one of the largest manufacturer of shunt resistors in the world. In fact, there are only 6 to 7 shunt resistor manufacturers in the world. Shunts basically are a simple product which goes into the battery management system. So whichever EV you are running, it will have a battery management system, right? It would be put up by Bosch or whatever, by a big company. And the battery management system will have a shunt resistor, which will make sure that the power that is going to the your vehicle is regulated. I mean, it's not overpowered or it's not undercharged, right? So that product has application in whatever 2-wheeler, 4-wheeler you're driving, or a smart meter which the electricity boards are talking about. So that product at a miniature level can even create wonders. The more its size are getting reduced, it is finding application in new age electronics and things like that. Now Mr. Gumman is a person who is recognized as the biggest expert of shunt resistors in the world. I mean, he can look at a shunt and see that what quality or what make it is and what kind of performance. And he, day in and day out, if you meet him or you talk to someone who knows him, he in his mind is preparing that how I can make the size a bit more smaller, how I can make a better product. So in India, look at a company like Shivalik who's exporting to Vishadale in the US, and Vishadale in turn is maybe supplying to Tesla and others. In fact, this company has added 2 clients from Japan, and Japanese are known for their own, you can say, quality consciousness, and they are relying on the quality of this small company. And if someone would have looked at this company in 2017, because of this story, it went up, right? It went up to 5-6x, but it came crashing down to almost 70-80%, and just became a 20 rupee penny kind of a stock, because someone just didn't believe that a small cap like this can maybe make that kind of a large business. But if someone looked at post the pandemic also, which auto ancillary companies are growing in India, this was the only company in auto ancillary, and I term it as auto ancillary because it's kind of providing a part which will go to the EV whole ecosystem, right? Only company which every month was growing its sales. I'm not talking about quarter, month after month, 25%, 20% kind of sales growth. right? And that was something which we were, very much surprised with, that how can a company grow its sales, because we saw that it is adding clients, which are graduating, and then after the test orders, they are giving more orders, right? So this guy with a 50 crores of capital, which it is, infusing in his business, can grow the sales by almost 200 crores. 150 to 200 crores. That's almost 3 or 4x of the capital that he's putting in the business. And it's a high gross margin business, and it easily pass on the cost, because the shunt cost in the whole battery management system is not even 2-3%, but its value is very high in terms of the performance that it is bringing, right? So that is where we believe that this is the kind of company which, if someone thinks of EV, should be betting in India rather than whatever else you're getting, because it's a direct play on the global EV market. Forget about Indian EV market. If global EV market grows, this guy has to grow. And that's what has happened. If you look at the auto index, has just given 4% kind of a return since your pandemic, and this company has just gone up 5x, right? So that's what that, and this is what, sometimes when you look at the longer term charts, you try to link with what happened in a particular business. The common thing was the high flying businesses sometimes provided opportunities differently in different segment of the whole value chain. There is some player in the value chain which and that is where sometimes I tell that the whole urban India, the kitchen got revolutionized, but the only guys who made money by revolutionizing the kitchen were the cooker guys, right? They're the only player who had the branded market, and the only thing that made money, right? No one else could make money, even though so many things we started to buy in our kitchen, and so modern kitchens we are making, but the only guy who made money were the cooker guys, right? So that's what, sometimes understanding the whole value chain is very important, because out of that value chain, every time you have 2 or 3 winners who are the bulk of the profitability, and they in fact grow at a very faster rate and have redeployment ability to grow their business.
Superb. Just to summarize, guys, you know what Arvind bhai is talking about is, first see the long term sector itself, whether EV is able to grow, and that within that value chain you find a niche player who is very highly profitable, and there is lesser competition. Now we have even talked about same theory in the telecom space, right? All the telecom players were fighting, but there might be a company who's making a software for all these guys, and they might be insanely profitable, right? So it's a very, very powerful approach. It's a good mental model to follow. And thank you for bringing that up. And you can see the chart and the kind of outperformance these kind of strategies create. Just see the chart and you will realize, right?
Correct.
That's the power of the entire format.
And it's not just Shivalik Bimetal, right? You could have, if you're wary of small caps, a formidable company like KPIT, right, who was making contracts with BMWs and other companies in the world to make a infrastructure for EV for them. So again, it was not at the forefront of technology. People think it is at the forefront of the technology. No, at the forefront of the technology is BMW. What KPIT is selling, boss, if you want to make your platform ready for EV, you give me a contract for 5 years. I'll be the middleware person. I'll connect you to the cloud guys. I'll do all this. I'll do the whole backend work. I'll plan whole manufacturing process and everything for you. And that's where you give me these dollars. Hence, it has fixed contracts. And those contracts, the more it wins, the more cost reduction happens at KPIT's end. And more people want to sign up, because KPIT has demonstrated that it has been successful in implementing it somewhere, and hence even the cost has gone down and the service has become better, and hence they want to sign up with KPIT, right?
Yeah.
So these indirect plays in EV have far higher power than the direct play. So that's what, again, the mental model that Vivek bhai was talking about is something we try to do. Sometimes we are successful, sometimes we're not successful, but that's what in the back of the mind. Again, Borosil Renewables was a story to the renewables, right? So if you looked at the first index which made huge return post the pandemic was the renewable energy ETF of the world. The solar ETFs, they just went over the roof, and it was crazy kind of behavior happening, and we were surprised why this is happening. And a lot of money was chasing the renewable assets, and that is where we started connecting the dots, that this guy Borosil Renewables in India had expanded. We met this management, they're saying China mein ye problem hai. Let us see. If people are thinking that renewables is the sector which post the pandemic is, in a way going up because so much money is chasing it, in India, can we find a story where this can happen? And we didn't want to buy people or buy companies which were making projects or which were, putting up solar projects, because the competitive game, 100 people would, bid. government would reduce the bid prices to 2 rupees or to 1.8 rupees, and then whether you make money or not, we don't know, right? I'm not saying that those people would not make money. What my mindset was that this guy, Borosil Renewable, would surely make some margin because the demand that is there and less competition that it has from China. And I already explained the logic that what was happening in China was something which was not happened in the last decade, right? And that money was chasing the sector. In fact, this was a report that we came across which highlighted that all the materials which goes into, making of a solar module, every other product was very volatile and had huge downsides or technology curves shifting the cost down in the longer term. Glass was the only component who over the past 20 years had not changed its trajectory much. It had similar kind of cost curves. It was a product which was not disrupted. It was required in whatever efficiency module you were buying or whatever technological revolution was happening with the module. So that in fact gave us even more confidence that this is not going to be a business which is going to be disrupted. And that again, what was happening around the world, a lot of data points we found that the solar PV cost has gone down so much now that, and if you look at around the world, many places the power of transmitting power, the cost of transmitting power has become far higher than manufacturing power for solar, right? So it is so insane that it is out of simple economics that you'll use solar power. Forget about the green revolution, forget about what the private players are talking about ESG. It is in their benefit, in their profitability to use solar power rather than anything else. And that was the revolution that had happened in a lot of countries at a different point of time. But between 2017 and 2020, a lot of economies around the world had come to that inflection point where the solar power cost completely made sense for the private sector to get into it and invest at a very fast rate. And that was what something was driving the sector. In India also, the capacity that gone almost 15x in the past 6-7 years, and it was expected to grow at least 8 to 10x more in the coming decade. And that's what again the tailwinds that were there. And why Borosil Renewables? Because solar glass was the less disruptive. And if you look at the financials of the company, right, did nothing, as I told you. From 2008 to 2020, you look at the financial loss, profit, you will not be able to make anything out of what is happening. And that is because the nature of the business was such that it was fighting the mighty Chinese, where it was not possible to win the game till they did something or till some structure change in the business. And that changed in 2020. And when we were, as I told that we were discussing this thesis with a lot of investors, they said that, already it's a bit up and this kind of businesses are not able to make more than 20-25% margins. But this was not there in China. We were telling them China people make 45% margin in glass business. And there, the price of glass at which they were selling is far lesser than what we are. And there is no cost advantage in China that the gas is cheap or, the silica is cheap. In fact, in India, the availability of gas was better. The availability of silica was better to the nearby to the Borosil plant. The only problem was the dumping. Yeah, the Chinese were selling it a fraction of their cost because they just wanted the capacities to be sold. And that dumping had to go because of the demand that had increased in the China itself, because they were using glass modules. Now, in a glass module, what happens is you have glass at the top and you have glass at the bottom, right? So that in a way increased the demand for glass substantially. And that was when we thought that there'll be a short supply of glass. And there were a lot of global reports that were highlighting that. And the Indian investors were not ready to listen because they had this 10 years kind of baggage that this business has not done anything, it will not do anything because of Chinese. The anti-dumping duty, whenever it will go, this business would again not be able to survive. But forget about the anti-dumping duty. The glass prices in China had gone up 3x. If you did the trade channel checks, if you, reached out to traders in China, they were saying that, there is huge shortage. So even if we didn't have this 10% kind of a, duty on the Chinese glass, it was so expensive. The container cost had gone up so high. So we were very sure that the coming 2 years for this company is going to be fantastic because the supply chains don't correct themselves. So that I told you, because we went 20% in a single stock, we wanted at least in the short term also, this company should at least not perform very bad, have some tailwind. So we were very sure that coming into a year, this company's business would be far higher what it did in the previous 10 years. If we get that kind of confidence, we can bet higher that even if, our thesis is wrong, maybe the earnings, when they will report, they will still make us comfortable that the stock would at least not fall dramatically. And with that comfort, we thought that if at all this business is able to display what we are hoping for, then it would be a game changer. Mind we see, when we entered, our focus was, okay, if the stock goes up 3x also, it's great for us. Because we had a big position, 3x also would make a lot of return, right? That was the initial thought process. But luckily for us, after we entered, the Malaysian duty structure was, so the Chinese they had anti-dumping duty, they were bringing it from Malaysia. That was fixed. We didn't foresee that, right? So a lot of luck events then followed up. A big private equity invested capital, they got fresh money to expand. Borosil for 10 years did nothing, just had 3x of the capacity from 180 tons a day to 450 tons a day. Now was aiming another furnace, which will take them to 1000 ton a day. And even before completing 1000 ton a day, they announced another 2 capexes, 500 each, which will take the initial, their total, capacity to 2000 tons a day. So from 180 tons a day, a company is planning to reach 2000 tons a day just in a matter of 3-4 years. That was a huge game changer. And we could not have predicted that. That luckily happened. But staying course and just having the comfort that 2 saal kuch nahi hoega, we gave ourselves this time horizon where luck chased us. And what happened is that if you observe the Chinese market closely, there you had 25-30,000 kind of tons a day player, right? And they were expanding 5-7-10,000 tons just for their markets. And they were not even interested to supply globally because their own market had such huge, capacity shortages. And those market caps were north of 80-90,000 crores. And here we had a glass player which had, in Indian geography, the only player, and which had the capability to even export to Europe now, because the European players, interestingly, were wanting to have alternate supplies apart from China, right? So Borosil, in fact, went and highlighted a strategy that we want 15-20% of our things to be exported. So it kind of made all sense. I'm not saying that we were so fortunate to be given those kind of mind by God that we could have anticipated that. But those 2 years where our Scuttlebutt told that we would not be losing money, at least on this trade, we'll have some good upside on it. And that hard work of collecting the Chinese data points, in fact, we were so lucky. I'll just share a graph, and these are the PV prices which were shooting up in China. We purchased logins from Chinese traders where we could get the data of monthly, glass prices. We were so paranoid that we didn't want to miss the price, because on a large position you have to have the data, and that urge is there that you should not be going wrong, right? Because every one of your investor friends are telling you, boss, isme paisa nahi banega, ye to glass prices abhi crash ho jayenge, ye ho jayega. So you have to have that. So we also cannot say that hum itne gyani the ki humko laga nahi ye hoega. We were also very concerned, and hence we tried to figure out data, get data, so that it backs what we were saying. People were questioning the quality of the auditor, that this guy, Mr. Pathak and associate, he whatever company people had invested, GTL or Crash Ventures, they've fallen 90%, 80%, things like that. These are auditors which don't have the quality. Again, these pictures were being shared on the social media, which in a way told us maybe if that happens, then what to do. But if we went and checked, did the financial due diligence, that who are the people who are consuming glass in India, right? These are the solar module manufacturers. Generally, these solar module manufacturers are MSMEs, right? Most of them in India. Getting data from them, and we were so lucky. Many people, even shared their ledgers. Okay, boss, this is my ledger. I'm buying glass at these prices from China, these prices from Borosil, this quantity. So luckily for us, and this is the chart that I'm showing you, where the table you can see the prices of glass which crashed during the pandemic, right? From September onwards, they started to go up. But in the month of December, they just jumped dramatically, right? Till December, if you look at Borosil renewable price chart, on the con call, if you look at Borosil renewable, no one is asking that, boss, why the glass price in China is so up? So we thought that people are still not aware what is happening in China, the Chinese situation, and the stock is underappreciated. And it kind of made sense what Borosil was reporting in numbers and what was happening with the pricing. The costing we could also, verify. So we thought, and it is something, you can argue that, that this could have gone wrong, that could have gone wrong. But a lot of data points that we were tracking did not make us believe that there was any corporate governance issue or there was anything in the numbers which could have been fudged, because they were complying with the industry data perfectly well, which in our samples could do. We cannot get 100%, but when it was, in a way in samples, the deviation was very small, in fact negligible. We thought that nothing wrong might have been happening. So that is where, I'm saying that, this is what allowed us to ride it maybe better. What I'm trying to tell you is this requires extra effort, but such kind of stocks happens once in 2 years, right? So spending that extra effort is worth it, because businesses are not changing their earnings trajectory every now and then. Hardly you got maybe chemicals way back in 15, 16 when they were changing trajectory. You got a lot of, you can say, building material companies in 2020 which were changing their trajectory. Generally, very few businesses change their trajectory. When they are changing their trajectory, if you don't go deep down and don't increase your allocation, that is where we believe we don't want to be in that position. We always want to go deep dive when the trajectory is being changed, and hence we go to that extent whenever we get that. So I guess that was the story of
how many of you found this mind blowing. The idea is, when you are right, you need to make it big. That is like the bottom point, right? And when you are right, to verify whether you are right, you need to do a lot of homework, right? So when you think that you are on a right direction and the market doesn't know about it, and it's a highly mispriced bet, and this generally happens in small and mid cap space. Large cap you will not find. Most of the time it might be otherwise. Market will be knowing something which we might not be knowing, but especially in the small and mid cap space, this is very, very possible, where the disclosures are low. Again, you see like companies like Shivalik Bimetal, HLE Glasscoat, Borosil Renewables, hardly there is any much of communication, and that is where the sweet spot is there. And when you are right, you need to make it big. That is where your portfolio, I'll probably show it after the case study, what is the outcome of this. We don't want to focus on outcome, but I'll show you what kind of returns and all those things he has been able to generate. But the focus is process. Whatever he's doing, just understand the nuances of the process, and that is where it gets mind-blowing and magical. Over to you, Arvind.
Vivek makes a very important point, that these large caps, so many times you would be wondering in the market, these large caps, they announce multi-million-dollar deals and the stock doesn't move. Why is that happening, right? Because such a big deal and the stock is not moving, because people mostly are tracking it so closely that they're aware of it. And a small cap, like for example, in Baroda, we have a company called Acrisil. They started doing business from Acrisil. Very few people knew about it, because if they did a bit of due diligence, you could have known about it, that how the business is being happening and what kind of numbers they were generating. That was something which few people got an acumen, but the market was completely unaware. One fine day, they declared this on the con call, and people are surprised, and the stock just doubles up in a quarter, because people now think that it's a story on IKEA in India, right? So and global IKEA, where it can be a supplier. So this is something, the surprise element, which generally comes with small and mid caps, because they are being tracked so thinly that people would be blown off their mind the kind of return that they can make by a significant development in the business, right? So again, HLE Glasscoat, again, I've discussed this. I'll just run through. I guess I've taken a lot of your time, so I'll just briefly go through, and we will maybe discuss few pitfalls, because that is also important, that where we went wrong and what learnings we had over there is also very, very important. So HLE Glasscoat, again, as I told, the business family, again, someone who knew the family. If someone who did not know the family, they would have said, boss, these are new people who are coming to the business. We don't know about their capital allocation skill. We don't know whether they'll give dividend or not. And that is right. You should think that way conservatively, that these are new people to capital markets. There's a private limited company, HLE Engineering, which went on and bought this Swiss Glasscoat. Now, why should we basically trust these promoters who are buying this company? But I just want to highlight few points. If someone went dig down into it, they would have found a lot of interesting things about the HLE Glasscoat family, which were missing in the earlier family, and they should have been far better, highly more confident with the business with them entering. Because if you look at HLE Glasscoat was into dryers and filters, and they were the largest player in dryers and filters. 55% market share. In glass-lined, Swiss Glasscoat had 25% market share, and GMM was the leader with 55% market share. So it made perfect sense for the HLE Engineering guys to have glass-lined product portfolio, to give a Divi's laboratory that, boss, you're buying a dryer filter from me. Here I have a, glass line also. And glass line players who were buying, glass line equipment from Swiss Glasscoat to tell them, boss, we have a dryer filter. In fact, what product, and if someone met the management and understood the business, Swiss Glass Coat, because it was a number 2 player, had smaller farm and smaller chemical plants as their clients, and actually had the larger guys as their client. So both client profiles were also diverse, and actually was able to convince the smaller Swiss Glass Coat clients that, boss, you cannot afford the complex dryers and filters that we make, but here we have made a standard dryer and filter for small people, for small businesses, and they're a perfect match for you at this cost. So they had a cross-selling opportunity to smaller Swiss Glass Coat chemical guys to sell dryers and filters to them, and to the larger guys of clients of Swiss actually themselves, convince them that Swiss Glass Coat's capability is no way less, and in fact we are improving and changing. In fact, it was always had that kind of quality. Now with us, you also have the and in fact, Swiss Glass Coat when the earlier promoter also running, was the only company which was providing repairs. GMM was not interested in repairs. So if it sold a glass line equipment, it also provided repairs, which gave a value add to the client, that if there is a problem, the repair would also be provided by the same company, and hence that gave the comfort. And that was, in fact, taken to a next level by the coming promoters to assure that larger clients, but we are there to help you around whenever there is a problem in the product. And that gave them this immense selling opportunity. Now that is okay. The business can do well. But if the business is doing well, what if these guys take out money from that business, right? That can be another concern, that why people would not be investing in the stock. But if, and this is a report that we wrote when the company's market cap was around 125 crores, the three musketeers, right? So out of the three musketeers, only actually Glass Coat became big, right? So that is what happens in investing. So the other two companies, which is Ice Maker Refrigeration, is still at the same market cap, or in fact 10% less than when we wrote the report at. And the other company, Rayalaseema Hypo, just 6 months ago, when we actually most of it exited, was on almost just 150% or 160%, but now it's almost went 3x in the past 6 months because of some tailwind. But I'm not saying that we wrote it because this was something that we were frustrated that it was not performing. But the only company that performed was Swiss Glass Coat, which became HLE Engineering. But what happened during the plant visits, and whenever we were going over there, the company's order book, and if you looked at the kind of turnover that they were targeting and the focus of the management, every time we met, every time we had more confidence. Now if you look at the merger that HLE did with the own company, HLE Engineering being merged with the Swiss Glass Coat, that was in fact one of the best corporate governance incident I had seen in corporate India over the past decade. They merged a larger entity, which was HLE Engineering, with a high market share by only diluting 25% of the equity of the listed entity. See, a larger business merging with your business and the minority getting diluted only by 25-30% was something that we were shocked. I mean, we were in disbelief why the promoter is doing that. And I just met them and they told that, we never wanted any confusion and we wanted to make it simple. In fact, it doesn't matter now, we are a family. So both shareholders would now be merged and things like that. So the approach was that within their own family, they wanted to structure their stakes. And that is why they thought that, merging it is better in a single entity which is listed. All the brothers have their stake and whoever wants to do anything in the future can do it and creates liquidity for the whole family. So the purpose behind the merger was so very clean in my mind. Whenever I've seen that people want to make, simplicity, I've seen great money to be made. And that was another point that convinced us that what market is concerned with is in fact not there. And that financial due diligence, because all the reports were public, people could have gone to the merger, document and seen what kind of dilution is happening. People could have gone to so this was a bit more that they should have done, but sometimes it becomes difficult, but you have to pay just 100 rupees. Go to the registrar of companies. You could have downloaded HLE Engineering's P&L and balance sheets, right, which was an unlisted company, but you could have easily done that. It was not very difficult. And in fact, Vikram from my team, he did that financial due diligence. He downloaded the past data for almost 7-8 years. He looked at the profit profile of the company, how they had scaled up their business, and how the merger and what the merger EPS would look like, and what kind of multiple we were looking at when the whole company gets merged. And at that numbers, if you look at it, was the combined entity was available at only 10x the multiple that they had already earned. If I looked at the forward earning synergies and everything, it was only available at a 5 multiple, right? And if you look at the company's profitability, HLE Engineering, they had gone almost 4 to 5x in the past 7-8 years. So, and the Swiss Glass Coat earnings was almost the same when they acquired. So there was chance that they could improve it because of the thing that they have shown in their own entity. So that's where, great multiplier returns happen. Now the market cap is around maybe 7,000, whatever, 75,000, 7,800, 8,000 crores. But I'm not saying we could have visualized that 125 crore company could go at 8,000. We thought that this business is at least worth 1,000 crores and these promoters would take it to that, because their family interest aligned the stakes were so high that below 1,000 crore business didn't make sense for them to do all these kind of things. And that was when Malabar got interested, and luckily we were the only report written on HLE was ours, and they contacted us because the promoters were not replying. And because Alap was my friend, I had to call him 5 times and scold him, boss, tum kya kar rahe ho? Malabar is a great fund. You should pay heed. You should talk to them, at least listen what they're saying, because they were ignoring them because they didn't know the background, right? So eventually Malabar gave growth capital to them at 1,500 crores value. And they expanded further. Now they bought a German company also. So that's what happens once you're in the game of wealth creation, right? Good people join, they give you growth capital, you put up more plants, you earn more at high multiple, you're able to tap capital markets, things like that. So everything kind of fell in place. We could not have visualized this, but the due diligence did initially. And the background check that these are good people, these are people whom we want to associate with, is enough. Sometimes you give yourself the room for luck to hit you, right? And that's what again happens.
Arvind, just sorry to interrupt. A question on the allocation side, right? So most of the times when we do these kind of things, as you said, there is always element of luck, and sometimes right thing happens right time, and then that significant upside happens. So what is your allocation approach? Do you go all in, whatever you thought, say it is 250 crore valuation right now, and you think it is at least 100 crore. It is a 4x kind of margin of safety. You might allocate well, but there might be situation where it could be possibility of 2x, and still it might take a lot more time to happen that, and sometimes even shit happens, right? Things might not go the way we wanted to. There might be COVID or any industry headwinds.
Different kinds of things,
yes. Right? So do you also add in the journey, when you feel that, okay, this trigger, we thought it might happen, it's an optionality, and now that is occurring, do you add up your capital or you prefer just going all in initially? What is that thought process? Because
so as I told you, we went up to 20%. Borosil was not in one shot, right? So initial allocation was 7%, right? Okay. When we thought this, just look at one quarter earning and see what happens. The 1 quarter earnings came well, then we got more data points, we took it to 12%, then to 15%. So what you're saying is perfect. And sometimes, you have what you have to structure your portfolio, because you don't think that, initially it would be a 10 bagger or a 20 bagger, right? Initially you're in your mind just hoping that it's a 3, 4, 5 bagger, whatever. And then you have other parts of the portfolio, which might be compounders, some things, because you have to structure the portfolio also to play it safe sometimes, because when you get confidence in Borosil, you have to sell something to buy Borosil also, right? Correct. So you cannot have another company, which is a very small cap, again because then it will fight, your mind would be fighting for ideas, right? You have with this company also, you feel good to 4x, this also. If everyone is a 4x in the basket, then how you increase your allocation, right? Exactly. So many a times people would say this, that how can you be so casual? But we go casually in picking up few stocks in our tail end of the portfolio. Why? Because we feel that we see, it is not that just for the sake of allocation we are allocating, but sometimes we're not sure that things will happen, but there are some insights that we've got from some of our entrepreneurs, and there is some evidence that we believe that entering late would be not that much great, because then we will not even able to allocate anything. So having a small allocation would help, and hence the tail sometimes is large, but the main allocations, which is almost 70% or bulk of 75%, is largely driven around companies which we believe can become very large. And that time, it is not that initially I'll have 20% in those 4 ideas, right? I'll start maybe 5-7%, but in 1 or 2 years we get a company where we can take it. It is, and at a point of time, at max we have had 2 companies only. Right. Which have gone to 15 bulk of the portfolio, or 20 and 15 kind of a position. Never we had 4 together, right? So that is where we believe the old portfolio allocation it is sometimes a very tough job to do that, but having comfort as the company is growing, as the things are getting performed, and then taking it up, because we made the mistake of allocating upfront. and then becoming very nervous,
Yes.
and then trying to, do all sort of stupid things to, justify our position, and eventually it has not, done well. So yes, what you're saying is no one can, have right. So only one company actually was the one company where right at the go we said, boss, इसको पहले से ही 10% लेते हैं, मतलब नहीं तो 5-7% से भी स्टार्ट कि 10%, because we took 7 months to accumulate the stock, because it was not having any liquidity. No liquidity at all. It took 7 months to just buy the company. We were worried कि boss बेचते समय क्या होएगा. Yes. If what we are thinking in our minds is not, because 7 months में, many people don't have a time horizon of 7 months in the market, right? Yes. But that is what something we were very much intrigued by the opportunity that we had, and we were thinking that the market is gone completely crazy on this one, because post the merger details getting announced public, the stock hardly moved 10-15%, which it came back after 5 days. So we thought whether the market is not convinced or what, but that time we allocated more, because we thought that this merger is going to change the whole game, because that merger was not announced. We never knew that this is going to happen when we built up the initial position. But when the merger was announced, we thought, boss, now this company's trajectory is completely going to be changed. And now the promoters' interests are completely aligned, because all their businesses are now in the listed entity, right? Mm-hmm. So that's where, the higher allocation happens. Mm-hmm. And if, for example, in the past where we've done a very high allocation upfront, and then the coming news, whether good or bad, whatever, we've seen our behavior not being correct. So that's where we believe that's how you tend to play it.
Super. And just to add, what is your typical the tail side of allocation, like very small tracking position? What is generally the percentage?
So range? 2% is at least what we look at. 2% in a single stock. We don't build 1%, but that 2% sometimes it will be like textile. We'll have the whole sector having 15%, in which a couple of stocks would have 5% each, and there'll be 3 stocks which will have 1.5 or 2 whatever. And so just to
basket
know
kind of approach.
In a growing sector, possibilities can be much more. So just to have a broadly all representation of maybe a garmenter, of a provider of these home textile and things like that, so that every sector is represented, and whichever does well then picks something, the other goes out of the portfolio.
Awesome. Yeah, how many of you are finding this insightful? Just type insightful in the comment box. Yeah, this is how you should be thinking, in terms of your allocation and how you add up your position. Yeah, super.
Perfect. So I'll just wrap it up in just 2-3 more minutes, and then we can go to Q&A actually. Yes, it's a Sunday evening and I don't want to bore you with much of what we've already covered. But the point is that, so now coming on to the mistakes, right? How to avoid mistakes, or how we in the past have done mistakes and try to take a leaf out of it, is sometimes when you're doing a lot of scuttlebutt, you are so much into, knowing the business, and so much into people who know the business and talk to them and try to get feedback from them, is that you ignore a lot of changes that need to be done on the balance sheet side of it. And you just look at the P&L numbers and what is happening in the business and feel that the P&L would only give valuation, right? You have to see a structural change in the balance sheet to also, give you the kind of returns that you're hoping for, right? So one such company that comes to our mind is Jindal Saw, where the P&L was growing, or it was the management was promising a lot of things on the P&L side. Business was looking good. And if you look at any kind of pipes in India, be it DI pipes, be it stainless steel pipes, be it the saw pipes, this company had across, all across. And it kind of made sense, because what the government was also saying, right? The government was saying that we'll do a lot of water, transport in India. Hence, the DI pipes were looking good. We have Jal Se Nal Yojana, this, that, infrastructure, everything, oil and gas. Each kind of product we thought was huge tailwinds. And this company, Jindal Saw, by capacity, in most of their verticals, if you still look at, they are one of the largest. And they were operating at 40-50% capacity in those verticals. And we thought the operating leverage can be huge if they can get those orders and execute it. And something changed that, the whole company, in fact, they made the business very bad by investing in US and things like that. But Mr. Neeraj Kumar, who initially built the business, again came back to the company in 2013 as a CEO. And he promised that, I'm going to change things, and whatever had happened in the past, because the promoters did this, that in the US business as out of the, and have been selling those businesses. And he was selling those businesses, they were going out. But the point was that the loss-making subsidiaries, whatever was being told, They were not adding up in the balance sheet or not reducing the stress of the balance sheet. Even though on the P&L side, things started to look a bit well. Margins started to go up a bit. Order book had that uptick. So we kind of got lured into, made a higher allocation as the P&L was improving, and got stuck because the balance sheet was not improving, right? So that's where this high allocation works reverse compounding for you, because you focus on data points. Your scuttlebutt gives you data, throws positivity around, government announces something, improves your, you say, confidence and things like that. And at that frame of mind, sometimes you are ignoring a very hardcore fact that every year the company is, filing its balance sheet, and you're seeing the stress not reducing, and you're ignoring that. And you're focusing more on the other aspects ke bole ye to ho jayega, but wo ho hi nahi raha. So that also is something you should avoid. And what we have learned a very hard way, that if that doesn't happen, eventually you don't make money. Whenever that has not happened, whenever the stress in the balance sheet has not gone away, whenever the business has not become a comfortable position post a good cycle and good order book, we've seen money not getting made. And hence, that is where we believe one should also focus on whether the management is walking the talk. And if you look at the loans and advances, they've gone up. They've not reduced. In a good business, you reduce them, right? You don't have to do capex because you already have done so much capex, in fact blunders of capex in the past, and hence your business is lesser efficient, and higher capex is not required because your own capacities can get utilized, and that predominantly should have been giving you higher operating margins. And that should have reduced your financial leverage, in fact given you even better return numbers. But that was not happening, and the management kept on guiding it. We kept on meeting them, they kept on guiding it, but never happened, right? So that's where something which we believe is something which in a way did the reverse compounding for us. In fact, there are many examples, right? People always boast of their success stories and talk less about what has not worked, but take it with a pinch of salt that whatever success stories we've discovered, whether be it HLE or Borosil, there'll be a Jindal Saw hiding behind it, right? So but what has happened is that over the years you have accumulated experience, and you continuously, when you try to do that, you have these case studies which give you this fallback, you can say, option where you go back and know that if these things are not improving, you don't make money eventually, and hence in the next cycle you are better prepared. So that's what has happened over the years, and we believe that lesser Jindal Saws kind of things have happened, and that has in a way given us confidence that whatever we are doing, that has come into a structure which becomes successful when we are in position where valuation is less, trajectory of earnings is changing, and we go for higher allocation. So we don't want to change that, because examples like Jindal Saw reduce our confidence that bolte yaar ye apna strategy galat hai, yaar apne ko itna high allocation jana nahi chahiye, investor ka paisa. Because see, sometimes what happens is when Jindal is at the forefront and some investor comes at that point of time, he will not have a good experience, right? So you have to train your investors, and over the period of time explain them that it can happen in a cycle that we have got a wrong guy leading the pack, and you have to calibrate it efficiently enough to make sure that goes out of the system fast, and someone who has the potential comes back at the forefront, right? So that is something we believe we've corrected over a period of time, and hence we now when we meet our investor, we tell them that this is something which is all a risk to your strategy, but over the years we have in a way tried to reduce the risk of those things happening, and getting out of it early if that has happened, and then calibrating back to the kind of companies that, and we will not change our high allocation side. We clearly tell them you can look at my returns and they will be volatile from 2018 to 19, and if someone looked at my return, he will say, boss, you are a mug in the market, what are you doing? Why you should not be a fund manager at all. It was so underperforming the index. But we tell them, boss, and that's the chart we want them to focus on first. Okay, boss, ye dekho, hamari strategy mein ye prone hai. We are prone to this kind of underperformance. If you're comfortable, then over a 5 years period, we can do well in the market. But if you can stomach this kind of a fall, then you are, definitely welcome, to be investors with us, because that is something is at the core of our success. We will not change. You'll tell me that why you're taking so much risk. I'm going to, and I will, because that is what has been working for me. I don't know what has worked with other people. I cannot be aping someone else's strategy and say that, I'll be doing that and I'll be very successful in doing something which the other does, because if I'm a batsman, I'm a batsman, right? I cannot become a bowler, right? So that's where we believe that I've tried to become a better batsman. Hence, I've tried to become better at handling stuff that, a bouncer, which, maybe got me out a lot of times. So we've become better at handling the bouncer, but we'll get bouncers in life, and that is what something one cannot avoid, right? So that is what is something has happened over the years. And yeah, I mean, key takeaways, we've discussed this intermittently in this, but the thing is that we always want to try different, you can say, businesses which are changing the trajectory for the medium and longer term, and that has not happened in the past, and that's why it gives them a high runway to grow. And also management's quality, which we can in a way cross check. See, because we are small cap investors, we have to have some fallback options, and that's where we leave a lot of companies where we don't have a fallback option. They can be simple stories, but we leave them because I don't have a way to cross check a lot of data points, and hence we're just not able to concentrate, because over the years we made that habit that things the data should be cross checked by us via various means. So yeah, that is what, and try to avoid a lot of pitfalls. Making sure that the balance sheet strength is also moving along with the P&L strength is something I'll tell you that I learned very late in my life. You guys should learn it early and try to gauge whether that is happening. If that is not going in sync, if the management is not doing that along with the P&L improvement, you will eventually not make money, is what something you should also take home about, is the point that I wanted to write. Anyways, thank you so much. Now I want if there are any questions you would want to ask.
Super. So what you guys can do is, just type your questions in the Q&A, and we'll be happy to take that forward. And I want to just show you some magic, okay, what all these translates to. So Arvind bhai, with your permission, I'll show you what kind of outperformance we are talking about. Okay, so just see what he has done in last 2 to 3 years. Okay, so this is what is the outperformance. Okay, so the key is, when you do this kind of differentiated research, you can actually outperform the market in a very, very big way. That is where I wanted to open up your vision also, that this is possible. A lot of time we are being forced in our mind that only 15% CAGR, 20% CAGR we should be focusing on. But as a retail investor, if you are actually putting hard work, and that is what Arvind bhai is doing, that kind of ground level research, it is possible in country like India, in the space which he is operating in, the small and mid cap, to outperform this kind of returns, right? So last year he has done like 107%, where the equity small and mid cap index was 127. So basically 27% was the returns for this index, and 107% was his return. As we speak, like, it is live, which I'm showing you. I've shared the link also. You can check it out in your comment section. This is what we are talking about, right? So the idea is to broaden your mindset that these kind of returns are possible, and of course there will be volatility. The space is volatile, and it comes with those kind of risks. But if you understand that space well, you can outperform, and you can make huge returns and beat the index also. Yeah. So that is what I wanted to open up your vision, that this is possible, and these guys are doing it live. It is not something.
Yeah, and Vivek would know that, just not us. I mean, he knows, yes, he himself and his friends in the fraternity who've done this. Yeah. I mean, they've done it in even better this process than what we have explained it today. And this is something which is, as a peculiarity we Indians have. We are hardworking people, and it's just that we need direction, right? It's not that these things you can argue that, some of the things we cannot do, how we can meet the management. It is there. There are a few gray areas. But there are value picker forums. There are so many forums. We've seen the data that is being shared in India, right? If you know a story, everyone is a storyteller, right? And if people love sharing stories, right? So if you're connected to the right people, you will get to know about the right story. They might have done the due diligence proper. You can maybe talk to them. Meeting people, talking to them would give you a lot of insight into good businesses that are happening in India. I don't think that retail investor is at a disadvantage. In fact, in India, we are looking at an advantageous position where a lot of these funds would not be able to buy a lot of category of businesses, where we are thinking the whole chain of earnings is going to change dramatically, and for few years the institutions would not buy them because of market cap criteria. And I know a lot of my fellow fund managers who are managing 7, 8, 10,000 crores worth of money. They're buying stocks in their own portfolio, but they'll not buy the stocks in their funds because the market cap criteria is not getting fulfilled. So I guess we are at a exciting times coming decade. Like China, we had had a manufacturing boom. We will have a boom wherein a lot of these businesses would be at an extreme advantage. And if you are able to work hard, I guess you'll get a lot of businesses right, and institutions would get it wrong, I guess, this time.
Yeah. So Arvind bhai, a very, very good question. And even, initially when I started my journey, I also had, and thanks to all the network I have, I could now hopefully do all these things. But they are asking, like, for a common man, do entrepreneurs entertain, and can we meet promoters, and is it easy, and what are some tricks you apply to get that connect? And sometimes it might be possible that even for fund managers, as you mentioned, even for Sumit Nagar, it was difficult to get connect and all those things. So then what are the workarounds to make it happen?
Correct. So it's a extremely important point, and that is where we in fact have been visiting AGMs for 5 years sometimes. For the 6th year, it is not big or small. The promoter should be seeing you. Yes. Right, that you came to the last AGM, you came to the other AGM, you came to that AGM also, and in the back of the mind he notices, boy, this guy is hardworking. It's not about the amount of fund you manage. If you show your hard work because initially way back in 2012-13 we did not have huge funds to manage, but it was a sheer you can say dedication that we were so much excited to meet these entrepreneurs, and like fanboys used to visit them, and they used to initially not be that comfortable, but for 4 years in a row he's seeing me in the AGM, and then he'll say, boss, come, we'll have a tea after the AGM and we'll just talk business around. So it's a myth that you might have these huge funds. Good people, I've seen good promoters, they want consistency, they want familiarity, and they'll be open to welcoming you or answering your questions. So that is where I believe as a shareholder. And these days, you can even go online and attend AGM, right? Your name is getting registered over there. You ask questions, you do your due diligence. I am telling you, if you ask proper questions, you get a mind share of the promoter for sure. I have got a lot of CEOs and CFOs, telling me, boss, do you represent any family office who's doing the same business or what? I mean, how come you ask such questions like a businessman wanting to start a business or things like that? And they've told that I've not seen no one in the past 10 years who asked these kind of questions, and the promoter was very happy that someone understands the business so well. You have to do your due diligence well. If you understand, as a retailer, you can do that, right? Because you don't have to manage someone's portfolio. You're free to spend all your year on a single business, right? I mean, that is a comfort that you could. And I have seen a lot of my fellow friends who had 2-3 crores of capital now have 150 crores, 160 crores. They're not managing anyone else's money. They had these large positions on Balaji Amines or few businesses, and they just rode it from 10 rupees to 2,000 rupees and things like that. Being a normal retail investor, just going religiously to the AGMs, following what the entrepreneur is doing, getting his mind share, getting him to talk to him because of the relationship that they've built as a fellow investor, invested in the business over a longer period of time. So yes, it seems that funds have that access in larger businesses. That might be correct. I know a lot of management who ask AUM before talking to you. Sometimes that can be a point of sometimes rejecting a stock also. That why do you want to know your AUM when you're approaching someone, right? So that's see, some people do because they don't want to don't have time to entertain a lot of things. But yes, you just need 15-20 stocks in your life, right? I don't think that is difficult to get by. The mindshare of few entrepreneurs definitely will be able to get by with your regularity.
Superb. Now, Shripad is asking, out of the 4 small cases you are, which one you are most excited about, and what are your thoughts on China Plus One? By the way, for people who don't know what is this China Plus One, this is the fund which we are talking about. So which one you are most excited about, and why this thought process of creating 4 different small cases?
Perfect. So it's a good question, and I tell to a lot of our investors that our small cases are branched out from our flagship small and mid cap. So our focus is on finding themes and finding businesses which can do good over a longer period of time, and hence the small and mid cap portfolio is housing a lot of. So earlier we used to be a bottom up stock picker, right? We used to find these companies and have these allocation. But post 2018-19, we saw a lot of Indian businesses which were doing very well and gaining, so like chemicals and all, gaining market share away from China. And post the pandemic, we saw a lot of these, green energy businesses doing very good. And power was a sector where we thought the past decade was underinvested with. So we thought our green energy basket would have a lot of power ancillaries and the way to play the green energy space or the renewable energy space and the EV space in India, which was, represented by companies like Shivalik, Bimetal or all. So we thought that there are investors who maybe just want to play a thematic kind of a portfolio, right? Mm-hmm. So China Plus One and green energy are branched out thematic portfolios which have, so they might have 20-30% similar allocation to our main, you can say, small cap portfolio, but then 70-80% would be different because that is structured around that theme. So I am most excited about the broad, you can say, growth that is going to happen in India, and that has lesser risk also. Hence, with less risk and a higher opportunity, which I'm playing in my small and mid cap as a flagship product, we are the most excited about that. But then these China Plus One or green energy, they have periods where they'll outperform my fund because they have high risk also, right? So for example, green energy completely blew out and outperformed almost 150 managers on the small cap, on the whole small case. In fact, no mutual fund gave those returns over the past 2 years, but that was because of the tailwinds that was there in the sector, right? Similarly, China Plus One, post this pandemic and post Russia, everyone is talking about supply chains getting so we are seeing past 6 months the China Plus One outperforming a lot of these funds, and the China Plus One emerging to be a very important leader. So we'll have these kinds of ups and downs, underperformance, but the way we communicate to people is that this is a flagship product. You'll have 20-30% China Plus One, you'll have 20% energy, and then 50% other businesses which we believe are structural, and we're seeing a lot of manufacturing grow in India. But then these are branched out things where thematically, if you want to have 10% allocation of your wealth in themes, I guess in shorter term, they sometimes outperform the overall trajectory. That's how we communicate.
Super. And Nitin is asking, what are the companies you have started taking position? Nitin, see, the idea for this session was to, teach you how to fish. Again, he is bound by the SEBI regulations and all that. He cannot talk single specific ideas which are current live in his small case because it will be unfair to their investors, right? So either you learn the way he has taught, or you can subscribe to his small case to know it. That is the only two options. So unfortunately, we cannot discuss stock specific ideas.
Yeah, and also the stocks that we've discussed, please take it for educational purpose. It was just to explain our strategy. This is no way a recommendation. As I always say, you do your own due diligence, you become an investor, so that is what has been the good part about these days, is that investors themselves can be informed and they can make their own thesis and have their own multi-baggers, and which is what the most important part of investing is.
Correct. So it is all case studies, whatever we have discussed. So take it with a pinch of salt, understand the process, like how to think like an entrepreneur, how to do ground level research, how to think about opportunity size, how to think about sector tailwinds. All these things will help you in your journey, right? So that is the whole intention of sharing these case study, not like a stock idea. It can very well go down or further up. That is totally what you need to take a call, okay, if at all you are investing in these. Now, Aravalipalli is asking how to identify these kind of companies. Like, what is the starting point? Like, as you said, we started ground level research, but what before that? Like, how to come to that Shivalik Bimetal, or how to come to that Borosil Renewables? What is that is your superpower to get to there?
So that's a brilliant question, and over the years, again, we didn't have anything in mind. We didn't used to run screeners, or we didn't have these checklists कि ये करेंगे तो इससे stock निकल के आएगा, right? We used just to roam around like wanderers, and sometimes would click, and then it would become a part of our portfolio. But what we've seen over the years is that this 40 to 50 group of people, entrepreneurs, that we tell them is a quality circle that we've made over the years. They represent textile industry, they represent jewelry industry, they might represent renewable energy, they might represent IT and these services. These are the people 70% of our winners have come from them. It was after discussing them that we hit upon a theme. For example, Shivalik Biometal, we had a guy who was a client in Bangalore. He's the global head of microchip in US, right? And he understood that technology very well. And he knew Vishedale and the other clients, and from him we got a lot of download on the technology. We got a lot of information about what is happening around with the US business and how shunt resistor business is doing for Shivalik, right? So that is somewhere that discussion would trickle Shivalik Biometal. So what we've done is, as a process now, as I told, every quarterly we speak to these 40-50 people, and they visit them almost on a yearly basis, and that is where bulk of the things come. Apart from that, now over the years, because you have written certain notes, a lot of these good investors like Mr. Ayush Mittal, founder Screener.com, he's a good friend. Vivek Bhai is a good friend. You develop a good investor base, and then you meet, you discuss ideas, you sometimes bounce off, maybe that stock, maybe something related to that clicks, and it is all within that circle of maybe 40-50 entrepreneurs and 20-30 good investors of India, whom is a quality circle we meet on an annual basis, and maybe on a quarterly have a talk to, is basically our hunting ground, right? We don't run screeners, we don't run anything else rather than doing that, and then we screen. So our process is different. First the stock comes, and then all the screening happens and all the other processes happen. So we do this, and hence that's why sometimes I tell my clients also that we run a risk of not having a theme which would be doing their good in the market, right? Like financial, right. We might completely miss it. And that's we are comfortable with, because something else which we might find the market might not be looking at, it will be available at a lesser valuation because the market is not looking at, and that makes up for the loss of the sector that we might have missed. But we are comfortable with this, and we plan to do that over the coming years also.
Yes, superb. Arvind, Anand is asking how Scuttlebutt Investing to be used for digital companies. Like, is there any way, or if at all you track that sector, how do you go about it?
So anyways, again, digital companies, example, I told you we have few clients in Bangalore. They are our go-to. So again, as I'm a commerce student, right? A lot of these science or technology companies sometimes, can haunt you in terms of, the understanding of the business. So your circle helps you. For example, there was a listing last year, MapMyIndia, for example, right? So we had two of the ex-employees of MapMyIndia explain the business to our team. Then our team took it along. They talked to a lot of automobile companies who use their product. So some chain reaction does help you in doing that kind of due diligence. Again, KPIT as an example, as I used. So it's not that you cannot do that due diligence in technology companies. It's difficult, I understand. But understanding the product and how it can become scalable is something you should always know in a business, rather than just saying that mid-cap IT in India is going to do wonders, hence I'm investing in mid-cap IT. You can do that, you can make a basket, you can make good returns. But if you understand some story and ride it because EV would help KPIT do these kind of wonders, then that's the time you make multi-baggers, right? So my suggestion would be that in tech, so for example CDSL, right? So that company, we were surprised that it had the highest operating leverage in any business that it can have in India, because to open more accounts, you did not do anything at all, no CapEx, small OpEx, and still it was having a market cap of just 2,000-3,000 crores. And all these HDFC AMCs of the world and a lot of fund managers we used to talk, they were buying this and they were saying that this is the future, these are the companies you should be buying, this is what the future of wealth management in India is, things like that. But the kind of valuation that they were, so value, I'm not saying be cheap value focus, but understanding, as I told you, initially that only cooker companies were the companies who captured the whole market cap of the whole kitchen, growth that happened in urban India. If you look at the whole financialization of savings, I guess CDSL came out to be a winner.
Yes.
So having that mindset and having the investor group, because we all are investors within us, we used to discuss, boss, CDSL को value नहीं मिलता है, ये फलाना TV पे आके HDFC के बारे में इतना बोलता है, and the market is favoring them in the short term. HDFC AMC is going from 2,000 to 3,500 something, and then in 3 years HDFC's AMC is 3,500 to 3,000 or whatever, 2,500, and CDSL is up from 250 to whatever 1,500. So sometimes having this quality circle and bouncing your ideas around certain type structure of business, because eventually whether it's IT, whether it's pharma, chemical, whatever, it is the business model which becomes a winner, right? Correct. So focusing a lot on the business model sometimes creates that kind of understanding that you at least get some idea not regarding the technicality of the whole thing, but about the business model, whether it can be successful or better in the longer term. At least you can compare two business models and get a judgment that this is a better business model. If I go to the technology business, these are the business models which I am more comfortable with, rather than buying the other kinds of companies, right?
Super. And I remember, in December 2019, I posted on CDSL on Value Picker Forum. Correct. And like all the negativity around it, like that this company, this, and they NSDL will take over, and all this kind of negative. And when the overall sentiment starts running, then you see that change in perception.
Complete change in perception.
That is very important to have that conviction also, during that period. Otherwise, we get swayed about all the noises that are around. So perfect. Amol is asking, how many stocks in the portfolio do you generally have? Like, what is the range of full position, tracking position? You might have tail of so many stocks, but like full-fledged position, what are the number of stocks you?
So we generally have around 18 to 20 to 23 stocks in our portfolios, not more than that. We don't try to make a bunch of so yes, but yeah, so we tend to over allocate in, as I discussed, in sectors where we are more bullish on, and that's how we go about it. The tails, for example, textile, when we are betting, then it will have 4 or 5 stocks and will have small tail also. But yes, we try to shrink it again and again whenever the sector is trying to play out. So it might go to 23, 24 stocks and again come back to 16, 17 stock, go to 23, 24, again come back to 16, 17, as and when that tail gets trimmed.
Superb. Abhishek Viman is asking very interesting question on skin in the game. Like, are your all equity investment part of the same small case companies which you recommend to your
100%. I have, in fact, it is sometimes I'm more allocated than 100% to those stocks. because
sometimes you have constraint also in the funds, right? Because you need to manage your risk at a portfolio level. But in
correct. So because you can go in small case, the problem is that I'm not able to gauge whether someone is coming for 5 years, right? So it is sometimes I have to curtail the risk in terms of my personal portfolio and my family offices that we manage with small case, because in small case there are people who might be coming for 2 years, right? And I cannot risk their capital with a 20% allocation upfront. There I'll maybe stop at 10% or 12%. So there we have certain criteria which I have to alter just for the sake of the benefit of the time horizon of the people that are joining. I don't know with what time horizon people are joining. But yes, out of the small case, many people ask us whether you can share a note of your company. I am, buying this stock for my personal portfolio. We try to guide them individually if they want to keep a stock, even when our portfolio might be trimming it or they want to do. So we try to educate more. We try to share our notes. I guess that's what the best we can do, right? We want people to make winning positions, and that's where we've thought that we have made our wealth creation journey. A lot of our fellow investors have done like that. So we also don't believe in throwing a nickel and dime around when you're allocating in stocks. So definitely we do that kind of end mile hand holding in terms of high conviction ideas. We share our notes, we completely and make them understand our thesis, and if they want, they can discuss with us whenever they want.
So next is from Ashish Gujarati. Very important question, like how do you avoid the ownership bias, because you are surrounded by all these, you said your circle, and most of the times when something happens interesting in the industry, they might be super excited and they might have their own bias because of their background in that same industry. Correct. How do you filter that? And second question is, are you seeing any opportunities in your fund or small case which can become like HLE or Borosil in future at this point of time, without taking names, just like, just to understand the future opportunities?
Correct. Perfect. Very good question. So yeah, that is what I have, also articulated during the presentation also, that bias we run. That when you're in close circle of these people, they can be so intimidating that you sometimes, get biased and don't sell the stock, even the numbers are not matching, right? So over the years, what we've done is, from the same sector, we are not relying on a single person, right? We are talking to 3-4% and trying to get an average around. You know by nature that this guy is more bullish over the years when you're knowing them, right? And this guy is overtly conservative when you know them over the years. So you try to average out their understandings. So that is one thing we do. Second thing very important we do is there are a couple of friends, in fact one of a person who's made again a small case with us, which is Trends Trilogy, is where they also look at price volume action and guide us also on the long term nature of the businesses, what happened in the US, the history of that particular type of business, the leader of the bull market, how they perform, and if there is something bad happens, there can be capital that can be flowing out of the company, and those things that they might be gaining, or you can say seeing that data better than us, and we might not be able to do so, listening to them. And hence over the years we feel that our exit strategy, when we've relied on a person like Mr. Bhavin, who's made a Trends Trilogy with us, has made us stay longer in our winning positions. Because as a value investor, sometimes we wanted to sell early, and he told boss, why are you selling the leader of the bull market? These are the time when these big funds are in, and you can see the volume these big capital is chasing, and you want to exit because this big capital also has a return expectation, right? And also exiting sometimes when the data, what we are seeing sometimes is sometimes making us biased, but the numbers and I'm not saying the data in terms of the financial numbers also are turning bad. The balance sheet structure is also turning bad, but my bias is telling me, nahi yaar, ek quarter baad aur kuch ho jayega. But Bhavin Bhai will tell me, boss, see, this is happening with numbers, this is happening with chart. These both are going in line, and hardly I've gone wrong when these two things have happened, right? So that's where we have started to reduce our bias and listening to them when the data is extremely, suggestive of our exiting somewhere we might have made a mistake, and hence that is what the best we are doing about it. The other part where I think a story which we have allocated a highest on our small case portfolio also is a MDF company, where we believe going forward the structure of the industry is changing. The company has did a huge capex whose replacement cost is almost 2x of what they did in 2018, around 450 crores of capex. Now if someone wants to do, the leader of the business wants to do, it will require 750 crores of capex to do. The industry itself is growing at 20-25%, and the imports in India are constrained because of you can say the South Asian nations now are going and exporting end furniture. So from MDF exporters to India, in fact, they are importing MDF from China and other geographies, converting into end furniture and selling to the US. So structurally, the whole industry has changed. India has 80% ply and 20% MDF and panel, versus the whole world, which is 80-85% panel and MDF versus just 20% ply. And ply is a very labor-intensive business. It has huge you can say disadvantages in the coming decade, and we feel that is up for grabs, because there's almost 40-50% of the ply industry which is unorganized also. So the organized players within the ply might even grow, but this 40-50%, only 10% might go to the organized, the 30% might go to the MDF is what our belief is. Awesome. And that's what we are playing the whole story in the coming decade.
Awesome. Guys, just a quick announcement. His colleague Vikram Bhai has just shared a coupon code. So exclusively for our community, Niveshaay has shared a coupon code which I've posted in the comment section also, which is additional 10% discount over and above whatever you see. So make most of it, and this is like for limited time they have shared with all of us. Yeah. So thank you, Arvind Bhai, for again that token of gesture and having a more discount for our community members. Really appreciate that.
Thank you so much.
Ramnathan is asking, for somebody who is putting money into your small case, like what is the minimum amount they need to invest every month? Like right now in your flagship, I think it's somewhere around 60,000 rupees, which is mentioned. Right? So 60,831. So if they want to do monthly, how much amount they can put every month?
See, everyone can put 5,000 also per month. That's not a problem. But what we suggest to our clients is that, as a percentage of expenses that you're spending, see, at least your portfolio eventually should grow to 5-7 lakhs, so that you should not be spending more than 2 or 3 percentage points as in fees, right? So the subscription charges, you do a calculation, the amount of investment you would reverse calculate that, if you invest 5-7 lakhs, then it will not make more than 2% of your portfolio. So you should plan your SIPs in a way that eventually your portfolio, so initially it might look big, your percentage might go up to 7-8%, but as the SIPs grow, the percentage of the fund that you're spending on subscription charges would reduce.
Right.
So I'll encourage you to make your SIPs in a way that the fund grows to that 5-7 lakhs kind of a at least a yearly run rate.
Right. And he's also asking how long we need to pay the subscription. Is it like, what is the renewal duration after this 6 months? Because there is only 6 months duration there.
Yeah, so this is something we are, constrained by the SEBI's law that you can only, have 6 months advance fees, right? So only six months subscription you can take, not on a yearly basis.
And will the subscription cost increase in the coming years?
We have over the years, in fact, been a lot of time intimidated, because a lot of people write to us that your research is good and you should, maybe even we want to pay you extra if you provide this, that. But we've in a way reduced, grown it very slowly, and we believe that this would not jump substantially higher. I mean, it might be 5, 7, 10% here or there, not more than that. I mean, you're not going to get doubled or tripled in a matter of time. Yes.
So Malhar is with us. He's asking, should one do Scuttlebutt over phone or visit physically? Or you can say, like, which works? Of course, physically works better, but have you also done with a phone call and have you found satisfactory answers? Hopefully, that is what he's trying to look at.
Correct. So before the pandemic, definitely visiting was something, but when you've over the phone also in the pandemic, you have in a way reduced a lot of your initial thought processes, and even on phone you get a lot of information, you get a lot of quality data and spending less time on, right? So that's what the pandemic has given us, the luxury of or a mindset that we also had that has gone away, that only visiting and only doing physical things only, but a mix definitely, I'll say, because visiting once in a while also gives a feel around how the employees are, what a new kind of recruitment happening, what is happening with the plant, small improvements you're able to. For example, in Aurangabad, I visited a factory, 3 years I've visited that. I could see a lot of on ground improvements which I could not have done via Zoom call, right? So that's something, if you want to get and feel, so once in a while you should also try to visit.
Right. Amazing. Hope you are comfortable for 5 to 10 more minutes for question. Hope it is not too much exhausting. I can see the energy, but yeah, just thought
people should not be saying no Sunday I'm boring them, right?
No. So that is always, we'll provide them recording. So if at all they are fatigued and they have some other thing, they can of course drop off. But yeah, hopefully you are not exhausted.
No, I'm completely fine.
So what is the exit criteria for your company? Like, how do you think about exits, and particularly for illiquid companies, right? You might have sometimes, as you said, like a case where you have accumulated over 7 months, and of course for selling also it could be very, very difficult. So what is the thought process and how it has evolved over years? So I'm sure it has improved and gone next level each time you do that. So, Sanjeev is saying this group wants more. Yes, dil maage more. Go ahead, please.
So yes, exit used to be in fact a pain point till 2015-16, where we used to either exit early and then we thought that we've exited this company, and then we stayed longer in a company and then it went the other way, right? So that's always used to be a tug of war what we should do. But over the years, what we've seen is 2-3 fundamental issues that we try to address, and then there is, again, as I told you, Mr. Bhavin, who also tells us about what's happening with the capital that is chasing what used to happen in the similar kind of earning trajectory plus charts around the world and in India comparatively. So what we have observed is that when we are seeing a lot of pessimism and when we are accumulating, maybe the volume is less, but if the company does well, it goes on the other side of the spectrum where every Twitter handle is posting about them. There is huge euphoria in the market, all TV channel guys. So we have a group of, so I say this, jokingly to a lot of my friends in the investment community also. There's a group over here in South Gujarat who calls me up on a stock, and generally when they call me up, I can almost predict that now the top is nearby, because they get bullish always on the wrong time. And when the story is new, there are concerns around. They're always like pata nahi ye hoega nahi hoega, and when it is kind of everyone is comfortable, good earnings, everything, and they call Arvind bhai ye stock aur le sakte hain kya apan is bhav pe. That is one very very important selling you can say signal for me. Apart from that, again we ask simple question like the market cap of the business when it grows, the earning capacity at that market cap if I were to do that business. Again, a very good friend from South India, a good value investor, taught me this, that you should not just look about what's the forward multiple and only thing, the whole market cap of the company. If you are sitting around and you start the business now, what kind of cash flow throwing, free cash flow generating capability at this market cap, does it make sense to have that business? That's another criteria that we have. And the third thing again is we look at a lot of these businesses in terms of the reinvestment opportunity, right? So as the reinvestment opportunity narrows out, that the business's scale has gone up and now growing would become difficult, that is the time we try to pull the sell button down, because it is something that people might argue that it's still this business can grow at 50%, 15%, but it has grown at 25%, and incrementally if it is growing at a smaller rate, even though it can add a lot of cash flow around and things like that, but the base becomes so big, and then we believe there are other opportunities that we can maybe buy. So sometimes it is also very very important that you exit your timing properly, because when liquidity is there. So, and we've done these mistakes earlier where we exited early just because liquidity came, and then the stock went up even 5-7x from there. But then you have to take this call, right? Because if the liquidity dries up and there are bad earnings cycles, and again then you have to wait for multiple years for the liquidity to come back, you could not be doing that. So yes, we have over the years tried to, so if it's a large position like 20%, we try to trim it when the stocks get identified in the market, right? People are talking about a lot of liquidity is chasing the stock. Even if the business is doing well, we expect the business to do well, still we trim it down by 5-7% because we feel it is getting over exaggerated, and then try to take a call how the business is doing, if the market cap as well, the growth opportunity has shrunk, and third is again confirming it with the numbers, the what is happening internationally, and to the whole sync of data and charts and everything if they are throwing up us. And we try to gauge a lot of selling points, a lot of distributors, a lot of data, monthly export data and things like that. And we have this trajectory where we feel that it is showing signs of fatigue, where newer clients are ordering less. So we track client-wise data. We track a lot of data, which these databases are somewhat have become very handy, wherein they give a lot of information, which we can in the backdrop, try to gauge the business intensity, right? Touch points of the business where they are selling. For example, someone is buying a motor from a company, and those distributors are saying that, boss, they sold a lot of motors, but now the market is, in a fatigue mode where whoever wanted to plan has planned. So that gives a signal. So these are it depends from business to business again. And always when we are entering a new business, because it might not have precedence, it becomes difficult sometimes to exit. But then we try to use the experience of a bit and try to trim it at whenever that stock becomes frenzy. That's one thing which has worked very well. And whenever there is a data where the decline in the stock plus the quarterly results are telling us that it should be something which we should be completely exiting, is something where we follow very closely.
Awesome. Now, Samir and others are asking, like, if somebody wants to subscribe to your small case, what if I have to invest in that mid and small cap flagship product? So I have to pay 60,831, what is right now, one time, and minimum 3 months subscription fee. And then what is the process next? Like, how can we see, and what process we have to do? Like, basically, once somebody puts 60,000 rupees and pays the subscription fee, what happens after that?
So the 60,000 rupees would go into the stocks that will be the constitute of the portfolio, right? For example, there is XYZ stocks, every allocation, those allocation would happen, and you'll get 60,000 worth of stocks in your portfolio. And whatever the subscription charges are, they'll go over and above that, and that will basically get deducted from your bank account, which you would not get any stocks for, right? So for 6 months or 3 months, whichever subscription you've taken, if there is any entry or exit, So you will get those updates, and you would get the email, and you, at the click of the button, if you approve that, the stock that we've exited would go out of your portfolio, and the stock that we've entered would come in your portfolio, or whatever allocation changes we might have done. A high allocation stock we have reduced, maybe it has gone up a lot or whatever, or the quarterly numbers we're not comfortable, we might have reduced some stock. So those things would happen for the 6 months, right? And then you have to renew for our guidance again. So that's how it works.
Superb. Rajan is complimenting, like, one of the key takeaways was keep reading different business stories. Could you share reliable sources from where you read these stories, and what are some of the industry reports where to get insights?
Correct. So anyways, in fact, so we tell people to read a lot of business journals, right? So sometimes what happens is that these business journals have either an advertisement, or either some product which has been highlighted, or some management interview that has happened, which intrigues you, that was this guy is doing something, right?
Yeah.
And then you try to talk to the community around. And in India, the thing is that you have so many relatives and so many friends, that you'll have some guy who is in chemicals, or some guy who's into some other, and you can get some connect. So I encourage you to read a lot of these business journals. And there are a lot of studies that get done. For example, in textile, there's a company called PDS, which a whole case study has been made by foreign universities, and that has been posted. So you should always be very much interested in reading those kind of stuff, where you get to know about what a promoter is doing, or what they've done over the years to structure a business.
Superb. Awesome. I think somebody is asking, Malar is asking, what is the thin line between insider info and scuttlebutt information? Very difficult question.
So many people, yes, tell me that, are you guys looking for insider information? In fact, during our scuttlebutt, if some promoter accidentally tries to, give any insider information, it's a completely no for us. Because, in the short term, you might feel that, you're getting an insider information. Wow, what great luck, this, that. But we have been, in this process, always made an ethical ground, and it has in a way paid off, because initially people used to tell us that, are you mad if you are privy to such an information, why not use it, things like that. But what we've seen is that and I'll tell you a story. In fact, a story which is actually what happened. There's a company called Ashampura Intimate Fashion, if you know.
Yeah.
Some chartered accountant who was our client in Vapi, they knew the management, and they took us to meet them. And I was surprised in the meeting, and DSP, BlackRock, and all these funds were invested in that. So we thought, it's a good space. Let us just talk. And the promoter, Mr. Harshad, he was telling us, boss, this is the collection I'm going to launch. This is the orders that I'm getting. This is the payout that, a lot of people who are invested with me would get. This, that. Tell me how much money you can get invested in my company. And I was, in a way, shocked that chartered accountant wanted, me to write a report, and he wanted his clients to invest at least 20 crores of his client's capital into that company. And I was surprised that why he wants to do that. I said, I'm not writing the report. And, we did a few channel checks then for him, because he was a long-standing client, and we didn't wanted him also to, disbenefit out of it. And we told him, boss, the reviews are a lot of his products are getting stuck. He's selling the product, but at the sales channel, we see a lot of inventory getting stuck. We were not sure what was happening in the company. I'm not saying that we predicted the corporate fraud, and we are the poster boys and things like that. But we could see that there is something which is fishy, and we should avoid it. Eventually, what happened, right? The promoter flee, the stock went to 1 rupee or whatever, it's zero or not trading right now. But the point is that, the agony that gentleman could have got by having those, 20 crores invested of his clients. In fact, he had made a position, and in one fine day when I got this, inventory data, I told my, operation guy to call the CA and tell him to sell all his stock, right? Whatever he had maybe personally bought. And he might have guided, and whatever happened, he might have had a dealing account where, some stock might not have been sold, whatever. But it is such a losing game to try to get any insider information. I'm sure, and I'm very confident that if at all you're getting it, you might be making money in the short term, eventually you lose it. I'll recommend not to do it at all, and avoid managements would give that kind of information.
Superb. Nitin is saying, he's getting some credit card error issue. Can we have some email or Vikram Bhai's contact to have?
Yeah. We can maybe share Vikram's.
I'll share his contact in the chat. Is it okay?
Yes. You can. Okay. He'll be able to handle.
So I'll just post the number of his colleague who can help you in any operational issue, just in case you are facing any. So you can just use this number. I'm just typing here. Okay, so you can just use this number and you can get in touch just in case. Okay. Can you talk about Trends Trilogy small case? Again, I'm not very sure if you have bandwidth to discuss, but yeah, if at all you want to.
Yeah, so Trends Trilogy, as I told you, Mr. Bhavin has been, guiding us. So Mr. Bhavin Shah, he is an individual investor. He used to manage his own portfolio. But since 2016, as a consultant, he had been, handling a lot of, as I told you, we struggled with the exit, right? So the exit strategy he has beautifully, made a transformation, because he analyzes, he has this data of 20 years of earnings, quarterly after quarterly announcement of companies mapped to charts, right?
Wow.
And I have not seen a single person who's worked so tirelessly on numbers, charts, foreign data, everything. And we used to initially we used to doubt that, whether this works or not. And we were so wrong, because in a sector, he used to pay, for example, textile, right? We used to make a basket, these three, and then we will, shift around. He'll pick Gokaldas exports, right? And Gokaldas would be the most outperforming stock. So over the years, we thought that he's just brilliant in terms of analyzing price volume with quarterly numbers and also themes which are happening globally. So we invited him, why not, you take charge, and, as it has been, your portfolio has been outperforming, on many occasions, your stock selection has been better. Sometimes he's not able to enter without price value action, which we are able to because of the Scuttlebutt, whatever. But then we've launched this Trends Trilogy, where we were very comfortable with his strategy, and we introduced to our family of investors, where we believe that his strategy, works very beautifully when the inflection cycle is, approaching.
Awesome.
So invest in stocks not at a very early, cheap age, right? When the inflection, and he writes that very beautifully, is what we've seen.
That is what I do. But yeah, as an individual investor, that is possible. As a fund, sometimes after a point, it is very difficult. So you have to accumulate. There is no other option. So yeah, Pankaj is asking on same lines, what is your current AUM, Arvind Bhai, if you want to share that?
Yeah, so our combined AUM is around 250-260 crores, around 100 crores in small case, and 150 crores of family offices.
Superb. Apart from that, hope I am not missing any other question. Okay. Somebody saying, do you provide any commitment to increase 60K by 3 months subscription time? No, so 60K is your actual amount. So there is some misunderstanding, Sushanta. So the subscription fees are much lesser. So if you see, let me just share the screen. Okay, so there are two components to it basically. So subscription fee is what you see here. Okay, so if you want to just test out and see how they are performing, and you want to see what are the strategies, you can actually use this particular subscription amount. The amount you see on the top is actually, the minimum investment amount. So that will be your stocks which will be bought in your account. So that is not something which you are paying for the subscription. The amount which you are paying is 2,999 for 3 months and 4,999 for 6 months. Okay. So this will remain in your portfolio. So like whatever 60,000 or 61,000 you put in, that will go to your portfolio. These will be like actual stocks bought from your broker based on the portfolio weights which Arvind Bhai has picked up. So all the stocks and weights which are there, that will get replicated when you do that process. Okay. So it's not a subscription of 60,000. Okay. So just be clear on that thing. Yeah. Yes. Yeah. So that is the case, Rajan. So think about this, so there are like, say Asian Paints worth 5,000 rupees, then say Pidilite of 3,000 rupees. And if you want to take one stock each, you need certain minimum amount, right? That is the reason there is this thing. And again, your cost is also a concern, right? So if you have like 10,000 rupees portfolio, and if you are paying like 3,000 rupees per quarter, you basically end up paying 12,000 rupees every year, right? That doesn't make sense. So you need a certain portfolio size, as Arvind bhai mentioned, if you want to, have that portfolio created, just to optimize your cost, basically. Yeah. Ram Prasad is saying, can we have multiple of 61K? That is the whole idea, right? If they want to scale up, Arvind bhai, please correct me.
Yes, definitely. So that is what is the idea, that you build a portfolio that your subscription cost becomes at least 1 or 2% of it, and that's where you make the multiple of returns,
Correct.
right? Because over the long term, you cannot be paying more than 2.5 or 3% of your charges on your portfolio. So if you can, it is fixed. It doesn't depend on the multiples that you buy, right? If you put 10 crores in a portfolio, still the charges are same. If you put 10,000 rupees, still the charges are same. So your benefit is, if you find the strategy good, if you invest more, your percentage of the capital that you're deploying as fees reduces dramatically, and you can basically enjoy the returns at a lesser cost.
Anup is asking, like, suppose we missed the exit alert, like you mentioned, you need to exit because he thought that it is a long-term portfolio, and whatever circumstances changed, and you pressed the sell exit button. Now, what is the time frame? Like, if we misses 1 or 2 days, is it okay, or
that's okay? I mean, see, this is not something which is so. Sometimes it's because of an event which is very, very important to sell. We, apart from the small cases, you can say newsletter, we still know that few stocks we had sent multiple mails in a matter of 2 days. Boss, please sell, remind us, everything. If that's an urgent matter, ourselves, we will make sure that you become uncomfortable till you don't sell. Apart from that, if within a week also you sell, that's okay. That's not a problem, because it's a sell, because we might have seen the numbers, we are not comfortable, or the stock might have gone up very high and now we want to trim and buy something else. So it's not that our volume is going to disturb a lot of what is happening. If we believe that it is going to happen, then we will make sure that you have multiple reminders to do that. If there is a corporate governance issue or anything which we want like you to exit out, then we will definitely push you to sell it.
Yeah, Krishnan is asking, will 60K will reside in my broker or your broker? It will be your broker. So whatever demat account you are holding, the shares will be yours. And even if there is a recommendation, one fine day, if you feel you want to sell it out, you can sell it out. Basically, the discretion is yours, but the platform helps you to replicate whatever portfolio is there. But it's still, you have full ownership with the stocks. That is how it works. On what frequency we get small case portfolio update? Like whenever you make changes, how frequent that
so it's happens? A monthly kind of a rebalance, but generally in a month there might be hardly any rebalance. There is a quarterly review that we do in our portfolio. The monthly what we track data is export data, and a lot of data, the monthly tracking that we do with the channel checks and everything. So if there is anything that has come up which requires us to change, then there is a monthly change. Else what will happen would be on the quarterly basis.
Okay. Yeah, I think Ashish Gujarati had same question on small case. Given trends is a trend driven strategy on small case, the rebalancing happens only once in 3 months. Is it not a too long a period? Like suppose there is urgent required, do you do that also?
Yes. So it's not that we will wait for the date. So sometimes midway also, if there is some changes we require in the portfolio, as I told, some trade channel checks or something gives us an information or something gives us a feeling that this is what something we should not be invested in. Midway also we write mailers and we change the allocation. It's just that on a monthly basis, the system in the overall scheme of things is that everyone would get a reminder that there's a rebalance date, and on a rebalance date, whether this needs to be done. We are not a very price volume action kind of a strategy which will do that in a shorter period of time. Hence, generally on a monthly basis, you will find lesser changes, and on a quarterly basis, you will find more changes.
Superb. One question from Sashi is like 60 is a whole amount, or we can scale up? I think it's a minimum amount. You can even put 60 lakh, 6 crore. There is no problem.
Correct.
Right? The more the better, because the fees will as a percentage keep going down.
So in fact, it's kind of strange. Hawkins Cooker family office, right? They were watching our small case performance. And the inquiry came to us via small case that we've watched your performance, we want to invest, and this amount. I said, okay, you can invest. I don't mind any problem. But they said, I don't want to invest in the through small case because as a corporate, we might have certain stocks which will not invest. So we want to have discretion. Hence, they open an account apart from small. So see, people can invest whatever they want in the small case. There is, the more you invest, the lesser cost it will pertain to you, right? Some corporates might, or some people have some issues, right? They cannot buy certain stocks because of being in a corporate, or they want to have some discretion. So hence they sometimes, for a larger amount, they get in touch with us that, we don't want to. So it's completely your call. As an allocation, you make sure that you're investing small and mid cap. So as a strategy of your overall portfolio, right, from risk perspective, if you're nearing your retirement or whatever, you should not have more than 25%, right? The younger you are, more you can have in small and mid caps. Yep. As you age, you should have, not more than 25-30% in small and mid cap as a strategy. If you are not a professional investor, right? That's what we guide to people.
Super. Now, Gagan Kaur has a question. Can we change from, say, mid cap to green energy? Suppose if you want to later, like between your small cases. And second is, do you also have a PMS?
We have a advisory portfolio, as I told you. The family offices that we guide are under the SEBI advisory license that we manage, and that is where we, give the allocations, and that is where we manage the portfolio under the advisory license. And you can shift between the small cases, but then that is, I guess, only on a quarterly basis you'll be able to do, because midway, anyways, it is a waste of money if you do for yourself. Why you'd want to do that?
Super. All right, probably we'll take this last question, which is, do you give reports of the stocks which you subscribe in the small case? Like,
so as I told you, the high allocation and the high conviction bets, we definitely provide, but it's not that we provide it when we are allocating, right? We have a cool off period of a quarter, because sometimes what happens is that, you don't know who is sharing the report where, and we don't want, when we are scaling up the allocation, the stock gets discussed around, or the reports gets, shared around. So that's the only reason why initially we have a cool off period until we have allocated the best that we can in our portfolios. We generally don't share, and post that we do share, and there is any questions, we do entertain that also on a company.
Superb. Thank you so much, Arvind Bhai. I think we have spent more than 2 hours with us, and it is amazing the energy and the passion at which you are doing this, and always inspiration to connect with you and know the entire thought process. We'll probably also connect sometime again in this platform. But thank you so much again for being here and guiding and so patiently answering so many questions. All of you just type MPTY. More power to you, Arvind Bhai, and keep doing the awesome work which you are doing. Yeah.
Thank you so much for inviting me, Vivek Bhai. I guess this has been one of my longest Zoom sessions. I guess you've built a community which is so eager to learn, and you've been so patiently listening to me. Thank you so much for inviting and having such wonderful session.
Thank you so much. All the members, hope it was insightful, and thank you so much for joining and being till the end. Much appreciated. And yeah, we'll try to have such amazing sessions in future also. So yeah, let's stay connected. And if you're not following Arvind Bhai on his Twitter account, just follow him. And also I'll share the link of his Twitter handle below the video recording also. Yeah, I'll share the recording and you can also watch it later. Thank you so much, guys. Take care. Bye-bye.
Thank you so much, Vivek.